Swing Trading. Chapter 4. Support and Resistance Trading Strategies. Support and resistance matter because they help us locate places where price has repeatedly changed direction. The most important mindset here is to think in areas, not exact numbers. Support is the area where a decline tends to slow, because buyers begin to step in, and resistance is the area where an advance tends to slow because sellers become more active. Traders often describe support as a floor and resistance as a ceiling, but both are better understood as zones with some width. Price rarely reverses at one perfect tick over and over again. If you train yourself to mark bands instead of thin lines, your chart reading immediately becomes more realistic. Some zones deserve much more attention than others because the market has already shown that participants care about those prices. A level becomes more meaningful when price has touched it several times and reacted clearly each time. Clean reversals are easier to trust than messy pauses, because they show a stronger shift between buyers and sellers. Volume adds another layer, since a reaction that happens with heavy participation tends to carry more weight than one that happens quietly. Higher time frame levels also matter more, because more traders can see them on daily or weekly charts. Strong never means guaranteed, but repeated visible reactions usually make a zone more important. Weak zones often look important only because we want to find a level on the chart. In reality, a single touch with only a small reaction is usually not strong evidence. If price barely hesitates and then moves through the area easily, that level has not proven much. Low volume near the zone can also suggest that the market did not show strong commitment there. Limited price history is another warning sign, because there simply is not enough evidence to know whether the area matters. Not every pause in price is meaningful, and weak zones are often the ones that fail fastest. Volume helps answer an important question. Did this reaction attract real participation, or was it just a small temporary pause? When price reaches a zone and volume expands, it suggests more traders were active there, which can strengthen the case that the level matters. A bounce from support on high volume, for example, often tells us buyers defended that area with conviction. By contrast, a weak reaction on light volume may be less reliable and easier to break later. Price shows us where the level is, but volume helps us judge how much market commitment stood behind the move. Used together, they give a more complete picture than price alone. A simple routine keeps this process clear and prevents overmarking the chart. Start with the daily chart, because it filters out much of the noise you see on lower time frames. From there, look for obvious swing highs and swing lows where price clearly turned. Then check whether those turning points happened more than once in a similar area. When they do, mark a horizontal band instead of a thin line so the zone reflects real trading behavior. Finally, glance at volume around those touches to see whether the reactions happened with stronger or weaker participation. Support and resistance should stay flexible because markets are always changing. One reversal can be random, while 2 touches begin to make an area interesting, and 3 or more touches usually make it more meaningful. Even then, a zone is never permanent. If price breaks through it on heavy volume, the market may be telling you that the old level no longer deserves the same respect. Sometimes a zone needs to be widened, shifted slightly, or removed entirely as new structure forms. Good traders do not defend old lines out of habit. They update their levels as the evidence changes. This support example shows why zones are more practical than exact prices. If a stock like AAPL bounced near 170, 20 in March, 170, 30 in May, and 170, 10 in July, those lows are clearly related, even though they are not identical. A realistic trader would combine those reactions into a support zone from about 170, 00 to 170, 40. That range captures where buyers repeatedly became active. If price returns there again, traders will watch to see whether buyers defend the area once more. And if those reactions happen on higher than average volume, the support zone becomes even more convincing. Resistance works the same way, but from the opposite side of the chart. If AAPL turned lower near 198, APL in turn the wager an APer, and again near 198, 198, 98, 90 in June, that cluster of highs suggests selling pressure appeared in roughly the same area. Instead of drawing one exact level, a reasonable resistance zone might be 198, 60 to 199, 00. That gives price room to test the area without forcing precision that the market does not really show. If volume increases as price reaches that zone, the case for resistance becomes stronger. Repeated stalling at similar highs is often one of the clearest signs that sellers are defending a level. A good way to test your own chart work is to ask whether another trader would likely mark the same zones. Use at least 3 months of daily data so you have enough history to judge repeated behavior. Try to find one support zone and one resistance zone that are visible and easy to explain. Record the price range of each zone, count how many times price reacted there, and note whether volume looked above average, average, or light. This turns chart reading into a repeatable process instead of a vague impression. If the zone is clear, repeatable, and easy to spot, it is probably worth keeping on your chart. Most mistakes with support and resistance come from forcing levels instead of observing them. One common error is drawing a single exact price when the market is really reacting across a band. Another is treating one touch as proof, even though a single reaction may be random. Traders also weaken their analysis when they ignore volume or use too little price history. Cluttering the chart with too many zones creates another problem because then nothing stands out. The best levels are usually the obvious ones, supported by repeated reactions, realistic width, and enough history to matter. Once you can identify meaningful support, you can begin using it to build actual trades. A support bounce setup starts with price falling into a support area that has already shown an ability to attract buyers. The trade idea is not just that price is low, but that the zone gives you a clear place to define the opportunity. If buyers defend support again, price may rebound toward the next resistance area. If support fails, the trade idea is invalid and you know where you are wrong. That clear structure is what makes support bounce trades so useful for swing traders. Before entering any bounce trade, you want 3 prices mapped out in advance. First is your entry, the price where you will actually buy if the setup confirms. Second is your stop loss, the point where you will exit if support does not hold. Third is your target, the area where you expect to take profits if the rebound works. Knowing all 3 ahead of time turns a chart pattern into a trading plan. It also helps you measure risk versus reward before any money is committed. Every support bounce trade begins with the support zone itself. That zone should be an area where price has reversed upward at least a couple of times before, not just a random line you placed on the chart. Think of support as a range, because price often dips slightly above or below the exact center of the area before turning. For example, if a stock has repeatedly bounced between 48.50 and 49.00, that whole band may be the useful support zone. Those prior reversals are what make the level worth watching. Without that history, there is no real reason to expect a bounce. Patience is critical here because support bounce trades are strongest when price actually tests the zone and responds to it. Buying while price is still falling can leave you stepping in front of a move that has not finished. A better approach is to let price touch the support area and then watch for signs that selling pressure is easing. One helpful sign is a close back above support after the test. That close does not guarantee success, but it suggests the zone may be holding. The sequence you want to see is simple. Test the zone, stabilize, and begin to bounce. A practical entry comes after price proves it is starting to turn, not while you are guessing at the bottom. One common method is to buy above the high of the bounce bar after support has been tested. Another is to enter once price trades above the prior bar's high, showing short-term strength. In both cases, the idea is the same. Let price confirm that buyers are taking control. You may give up the exact low, but you gain a more reliable signal. In swing trading, confirmation is often worth more than perfection. The stop loss belongs below support, not directly on it. If you place the stop right on the level, normal market noise can knock you out even when the setup is still valid. Price often wiggles around support before the bounce develops, so the stop needs a little room. Many traders use a volatility tool like ATR to estimate a sensible buffer below the zone. The goal is balance, wide enough to survive routine movement, but not so wide that the loss becomes too large. A stop should protect you from being wrong, not from every small fluctuation. For the target, the most logical destination is usually the next resistance area. If the chart shows a clear prior swing high or overhead resistance zone, that gives you a realistic place to expect a rebound to slow. If resistance is less obvious, you can fall back on a reward to risk framework and require at least 2 units of potential reward for every 1 unit of risk. For example, if you're risking 50 cents per share, you might want at least a $1 upside target. This keeps the trade attractive even if not every setup works. Good targets come from structure first and ratios second. Let's put the pieces together with this AAPL example. Suppose the support zone sits between 148.50 and 149.00 and price tests that area, then rebounds. An entry at 149.25 would mean you waited for the market to show strength rather than guessing at the exact bottom. A stop at 148.00 sits below the zone, giving the setup some breathing room. If resistance is near 151.80, that becomes a logical target for the trade. This is what a complete bounce plan looks like. Support identified, rebound confirmed, risk defined, and target chosen before entry. Before taking the trade, you want to check whether the upside justifies the downside. In this example, entry at 149.25 and a stop at 148.00 creates a risk of 125 per share. A target at 151.80 offers a potential reward of 255 per share. That is a little more than 2 times the risk, which makes the setup more appealing. This calculation matters because even good chart patterns should be filtered through risk and reward. A defined setup is helpful, but a defined setup with favorable math is much better. Once the trade is open, discipline matters as much as analysis. If price reaches your target, take the profit as planned, and if it hits the stop, exit without negotiation. You also want to pay attention to follow through after entry. If the bounce is weak or price repeatedly rejects at nearby highs, that can be useful information about the quality of the move. Common mistakes are buying too early, setting targets that are unrealistic, or widening the stop after the trade is already under pressure. A solid bounce strategy depends on respecting the plan after entry, not just building it beforehand. Support bounces focus on buyers defending a floor, while reversal trades at resistance focus on sellers defending a ceiling. The challenge is that when price reaches resistance, you do not know in advance whether the level will hold or break. A strong move into resistance can become a breakout just as easily as a reversal. That is why confirmation matters so much. Selling simply because price touched resistance can leave you fighting genuine strength. A better approach is to wait for price evidence that sellers are actually taking control. Before a full reversal pattern appears, the market often gives smaller warning signs that buyers are losing momentum. You might notice candles getting smaller as price approaches resistance, which suggests the advance is slowing. Long upper wicks are another clue because they show price tried to move higher but was pushed back. Sometimes you will see a cluster of small candles just under resistance, showing hesitation and indecision. These are useful signals for attention, but not for entry by themselves. They tell you to watch closely, not to act early. Just like with support, reversal trades at resistance work best when the level already has meaning. Start by marking a horizontal resistance area where price has turned lower at least 2 times before. A third or fourth test often deserves even more attention because repeated reactions show the market remembers that zone. Even so, repeated tests do not guarantee a reversal. Sometimes a well-known level eventually breaks because the buying pressure has built up enough to push through. So the goal is to respect the level while staying flexible about the outcome. How price approaches resistance can influence whether a reversal is likely. A fast, aggressive move into the level often increases breakout risk because momentum is still strong. On a 1-hour chart, reaching resistance in fewer than about 3 bars often looks urgent and forceful. A slower approach that takes 6 or more bars, with more overlap and pauses, usually looks more labored. That kind of approach can support the reversal case because it suggests buyers are running out of energy. This is not a rigid rule, but it is a useful way to judge context before the pattern forms. Once price reaches resistance, the next step is to wait for a recognizable bearish confirmation pattern. A bearish pin bar shows rejection through a long upper wick and a close off the highs. A bearish engulfing pattern shows sellers taking control when a strong bearish candle covers the prior bullish body. An evening star adds a 3-candle sequence that shifts momentum from bullish to bearish. Each of these patterns tells a similar story, Buyers pushed upward, but sellers pushed back harder. The key is to let the pattern fully form on a practical chart, such as the 15-minute or 1-hour time frame. A reversal pattern is only tradable after it is complete. Acting while the candle is still forming can lead to false signals, because a bearish-looking candle can change dramatically before the close. Many traders wait for the candle to close and then use a move below the pattern low as the actual entry trigger. With a pin bar, for example, the break below its low is a common confirmation. That extra step helps prove that downside follow-through is beginning. It is a simple habit, but it filters out many weak setups. Before entering the reversal trade, you need a clear stop and the logical target. A common stop placement is above the highest wick in the confirmation area, because a move through that point weakens the bearish idea. For the target, the nearest support zone below is usually the most natural destination. Then compare the distance to the stop with the distance to the target. Sometimes a reversal pattern looks technically valid, but the support below is so close that the reward is too small to justify the risk. In that case, the right decision may be to pass on the trade. Here is how that process might look in practice. Imagine a stock rising slowly toward well-defined resistance near 55 after reversing there several times before. The slow approach suggests momentum is not especially strong, and then price briefly pokes above resistance before forming a bearish pin bar. If the entry comes after the close at 54.80, with a stop at 55.20 above the wick, the risk is about 40 cents per share. A nearby support target at 52.00 offers about 2.80 of potential reward. That creates an unusually favorable reward to risk profile, roughly 7-to-1, built from structure rather than hope. Most poor reversal trades fail because the trader rushed or ignored the surrounding context. Entering on the very first touch of resistance is a common mistake, especially when there is no confirmation at all. Ignoring a fast, powerful approach into the level can also be dangerous because that kind of momentum raises breakout risk. Very low time frames add noise and often make ordinary fluctuations look more meaningful than they are. Another mistake is focusing so much on the candle pattern that you forget to check whether there is enough room to the target. The pattern matters, but the full setup matters more. A good way to build this skill is through chart review rather than live risk. Find a market where resistance has been tested at least 3 times on a 1-hour chart. Mark the level clearly, then wait for a bearish pattern to close at that area. Write down the hypothetical entry, stop, and target before looking ahead. Then study the next 10 candles to see whether the trade reversed, stalled, or broke through resistance instead. This kind of practice teaches patience and process, not just candle recognition. So far, we have focused on trades that bounce from support or reverse at resistance. Another useful environment is the range-bound market, where price moves sideways instead of trending. In a range, price rotates back and forth between a lower support area and an upper resistance area. Resistance acts like a ceiling that keeps stopping advances, while support acts like a floor that keeps catching declines. For swing traders, the opportunity comes from working those repeated swings between the two boundaries. The key is recognizing that the market is moving sideways, not building a strong trend. Horizontal levels are especially important in a true range, because buyers and sellers keep defending similar price areas again and again. This is why flat support and resistance zones are usually more useful here than diagonal trend lines. A healthy range shows repeated highs near the top and repeated lows near the bottom. The more times price respects those boundaries, the more credibility the range gains. But if a strong trend is clearly overpowering the structure, it may not be a real range at all. In that case, trying to trade it like one can lead to poor entries and weak expectations. Not every sideways chart is worth trading. A tradable range should have clear structure that is easy to recognize without forcing the idea. You want visible highs and lows, at least 2 touches near each boundary, and reactions that are reasonably consistent. It also helps if the market has spent several sessions moving sideways rather than just pausing briefly in the middle of a trend. Clean ranges are easier to plan around because both edges are more obvious. Messy overlapping action with unclear boundaries is usually better left alone. The best entries in a range usually come near the edges, not in the middle. Near support, a long trade can offer tighter risk and more room for price to travel toward resistance. Near resistance, A short trade can offer the same advantage in the opposite direction. The center of the range is often the least attractive area because reward to risk is weaker there. You are too far from the invalidation point and too close to both potential turning areas. Patience improves range trading because waiting for the boundary often gives you the cleanest structure. A boundary alone is not enough to justify a trade. At support, it helps to see confirmations such as a hammer candle or a bullish engulfing pattern that suggests buyers are stepping in. At resistance, you want signs of bearish rejection, such as upper wicks or a bearish engulfing candle. Strong closes away from the level make those signals more meaningful because they show a real response, not just a brief touch. This is the same principle we used earlier with bounces and reversals. The level gives the location, and confirmation gives the evidence. Stops in range trades should sit beyond normal noise, not exactly on the boundary itself. If you buy near support, placing the stop right on the level can get you shaken out by a routine dip. Many traders use about 1 ATR beyond the boundary, or they place the stop beyond a recent swing low or swing high. The same idea applies to shorts near resistance. The stop should reflect where the setup is truly wrong while still allowing for ordinary volatility. In other words, tie the stop to the market structure, not to a random number. Profit targets in a range are usually based on the opposite side of the box. A long trade entered near support will often aim toward resistance, and a short trade from resistance will usually aim toward support. Many traders choose to target slightly inside the boundary rather than exactly at it, because price can reverse just before reaching the line. That small adjustment can improve the chance of getting filled. Some traders also scale out part of the position at the midpoint of the range. The goal is to be practical, not perfect. Range trading only works while the range is still behaving like a range. A strong close outside the boundary is one of the clearest warnings that the structure may be failing. If that break is supported by expanding volume, the signal becomes more important. Weak bounces from support or weak rejections from resistance can also warn that one side is losing control. Once the market changes character, forcing another bounce trade usually becomes a mistake. Good traders stop treating the market like a box once price shows it may be leaving the box. This example shows how a range trade might be planned. Suppose ABC has traded between 50 support and 60 resistance for 4 weeks, with 3 tests on each side. Price returns to support, touches 51, forms a hammer, and closes at 52. That gives a possible entry at 52 with confirmation near the lower boundary. A stop at 50. 25 sits below support, while a target at 59. 50 aims just inside the upper boundary. The trade works because the range is clear, the entry is near support, and the risk is defined before the order is placed. This example also shows why range trades can be attractive when the structure is clean. If the risk per share is 1.75 and the potential reward is 750, the setup offers a reward to risk ratio a little over 4 to 1. On 100 shares, that would translate to a potential profit of $750 if the target is reached. Those numbers do not make the trade certain, but they do make the opportunity worthwhile. Good habits still matter. Enter near the boundary, wait for confirmation, place a realistic stop, and target the opposite side of the range. Clear structure and controlled risk are what make range trading useful. Eventually, every trader runs into the problem of false breakouts. Price moves beyond an important support or resistance level, breakout traders jump in, and then the market quickly reverses back through the level. What looked like the start of momentum becomes a trap. The core issue is that a breakout only matters if price can stay beyond the level. If it cannot hold there, the market is not truly accepting the new area. Recognizing this idea is essential for managing breakouts with more caution. Traders get trapped around key levels because those levels attract a cluster of orders. Entries, stops, and exits often pile up in the same place, so a small push through the level can trigger several things at once. That burst of activity can create the appearance of real momentum, especially for traders watching the breakout in real time. But once that burst fades, price may snap right back. In other words, the move through the level was enough to trigger orders, but not enough to create lasting acceptance. That is why breakout traps can feel convincing in the moment. A brief poke above resistance or below support is not confirmation by itself. Many weak trades begin because someone treats the first touch or first small break as proof. But the more important question is whether price can actually hold in the new area. If it cannot, then the breakout has not really succeeded. Waiting for additional evidence may feel slower, but it helps avoid low-quality trades. Patience around the level is often what separates a disciplined breakout trade from a fakeout. A simple confirmation process can improve breakout quality. First, let price move clearly beyond the level rather than just barely poking through. Some traders use a rough guideline of about 0.5% to 1% beyond the level to show the move has some substance. Second, wait for the candle to close beyond the level. Third, watch the next 1 or 2 candles for follow-through. When you see distance, a close, and continued movement, the breakout has more evidence behind it than a single intraday wick. Retests often create stronger breakout entries because they ask the market to prove the move twice. After a breakout above resistance, price may pull back and test that old resistance as new support. If the level holds, you gain added confirmation and often a better entry with a tighter stop. The same logic works in reverse when old support becomes new resistance after a breakdown. This is usually a better situation than chasing the first breakout candle after it has already extended. Retests slow you down in a helpful way and often improve risk-reward. The stop loss for a breakout trade should be placed at invalidation, not at some arbitrary distance. Use the broken level as your reference point, then place the stop slightly beyond it to allow for normal noise. For an upside breakout, that often means below the new support area created by the old resistance. If price falls back through the level and cannot reclaim it, the breakout idea is probably wrong. At the same time, avoid making the stop so wide that the loss becomes larger than the setup deserves. A good stop is tied to the logic of the trade. This Euro SVSD example shows the difference between a false break and a confirmed one. On the first attempt above 1.09, price pushed through the level but failed to close strongly and showed no real follow-through. That made the break weak, even if it looked exciting for a moment. Later, price broke 1, owned and under again, closed above it, and then held the area on a retest. That retest offered the stronger entry because the market had shown acceptance above the level. The key difference was not how far price moved at first, but whether the breakout was confirmed. Even a confirmed breakout can start to fail after you enter, so trade management still matters. A brief dip back into the level may be normal, especially during a retest, but a close back inside the old range is a more serious warning because it suggests the market is no longer holding the breakout area. A fast move back through the level can be an even clearer signal that the idea is breaking down. If the setup is invalidated, exiting is usually the disciplined choice. Managing a trade well means asking whether the original reason for entry is still true. Most breakout mistakes come from speed and poor context. Entering on the first break is common, but it often means buying or selling before the market has proved anything. Stops that are too tight can get hit by a normal retest, even when the breakout is still valid. Chasing a large breakout candle often creates a poor entry far from the invalidation point. Traders also make mistakes when they ignore the broader trend or overlook weak momentum behind the move. Confirmation, context, and structure matter much more than excitement. A practical way to improve is to compare false breakouts with stronger confirmed ones on recent charts. Start by marking a support or resistance level that has been tested at least 3 times. Then find one example where price broke the level and quickly reversed back into the range. After that, find another example where price broke, closed beyond the level, and then held or retested successfully. Compare what confirmation existed in the stronger setup that was missing in the track. That exercise trains your eye to focus on evidence instead of movement alone. The main lesson of this chapter is simple: important levels matter, but evidence matters more. False breakouts are common, so the answer is not to predict better, but to demand confirmation before committing capital. A stronger breakout usually shows a clear move beyond the level, a close beyond it, and either follow through or a successful retest. Those extra steps may mean entering later, but they often improve trade quality and reduce traps. In swing trading, patience is not hesitation. It is one of the ways you protect both your capital and your decision making.